Wall Street and Bay Street today. Let's take another look at what's happening with Canada's currency. The loonie right now slightly higher against the American dollar, but we have seen a steady slide in the loonie. Why have we seen the Canadian dollar weakening against the American currency?
I think there's been a profound divergence in economic data coming out of the U.S. and Canada. Firstly, you have the U.S. steaming ahead, much stronger growth than expected, wage inflation pressures still remaining, prices still continuing to rise, excess demand still there, consumers continuing to spend, businesses continuing to invest. All of that stuff has been lifting the U.S. dollar on a secular level against everything in the world.
In the turbulent seas of global finance, few events send shockwaves quite like the collapse of a nation's currency. This nightmare scenario isn't a dystopian fantasy, it's a genuine possibility facing Canadians today as the phantom of a collapsing dollar looms larger on the horizon. As if that weren't enough, ominous headwinds owing to the loonie decline lurk on the horizon, threatening to unleash bedlam and uncertainty on an unprecedented scale on Americans' northern neighbors. The Canadian dollar, a currency that has long been a symbol of stability and prosperity, is now facing an unprecedented crisis that threatens to sink it beneath the waves. For decades, the Canadian dollar has been a key player in the global financial system. As the currency of one of the world's largest and most diverse economies, it has been a reliable store of value, a hedge against current commodity positions, and a trusted medium of exchange for investors, traders, and businesses around the world. In 2022, the Canadian dollar ranked as the sixth most traded currency in the world, with an average volume of over $166 billion. But in recent years, the once mighty loonie has begun to falter. Its value has been slowly but steadily eroding, falling from a high of $1.06 US in 2011 to just $0.75 US in 2023. This decline has accelerated in recent months, with the Canadian dollar losing over 5% of its value against the US dollar in the first quarter of 2023 alone. As of March 2024, the Canadian dollar fell against its broadly stronger US counterpart, registering a weekly decline. The loonie was trading at 0.6% lower at 1.3605 to the US dollar, or 73.50 US cents, stopping just short of its weakest level in 3 months at 1.3613. Currently, the currency is at 0.7277, down from 0.743 1 year ago. In recent months, whispers of economic turmoil and market instability have grown into deafening roars, signaling a perfect storm brewing for innocent users of the Canadian legal tender. As investors brace for impact and policymakers scramble for solutions, the question on everyone's mind is clear: can Canada weather the storm, or is the nation on the brink of an unprecedented economic catastrophe? In this video, we will delve into the heart of the matter, uncovering the underlying forces driving the collapse of the Canadian dollar and exploring the potential consequences for individuals, businesses, and the nation as a whole. Over the years, the loonie has evolved alongside the nation's economy, transitioning from a fixed to a floating exchange rate regime in the 1950s. However, this legal tender has faced significant challenges in recent years, with its value declining against pace-setting currencies like the US dollar. The reasons for this decline are complex and multifaceted, but they all point to a growing sense of unease and uncertainty about the future of the Canadian economy. One of the most significant factors weighing on the loonie is the ongoing slump in commodity prices, particularly oil and gas. As a major exporter of these resources, Canada's economy heavily depends on the health of the global energy market. When prices are high, as they were in the early 2010s, the Canadian dollar tends to strengthen. But when prices fall, as they have in recent years, the loonie tends to weaken. According to Statistics Canada, as of March 2024, the average annual price of West Texas Intermediate crude oil reached $77.56 US per barrel. This closely mirrored the 2023 average and was a notable decrease compared to the 2022 average, which stood at $94.9 US when oil prices rose following an energy supply shortage in the fall-winter of 2021-22. This volatility has taken a heavy toll on the Canadian energy sector, which accounted for 11.8% of the nominal gross domestic product, or GDP, in 2022, directly employed 290,300 people and indirectly supported over 405,000 2,800 jobs. However, the Canadian dollar's challenges go beyond just the vagaries of the global commodity market. There are also growing concerns about the health of the Canadian housing market, which has been a key driver of economic growth in recent years, but which is now showing signs of stress. According to the Canadian Saltwire, the average home price in Canada fell by 4.6% in 2022, the first annual decline since 2008. In some major cities, such as Toronto and Vancouver, prices have fallen even more sharply, with some analysts warning of a potential housing market crash. This is a major concern for the Canadian economy, as the housing market is closely tied to consumer spending and overall economic growth. When housing prices rise, as they have for much of the past decade, homeowners feel wealthier and are more likely to spend money on renovations, furniture, and other big-ticket items. But when prices fall, as they are now, homeowners may feel less confident about their financial future and may cut back on spending. The Bank of Canada has also warned about the high levels of household debt in Canada, which have risen to record levels in recent years. According to the Canadian Broadcasting Commission, the proportion of household disposable income in the third quarter fell to 181.6% on a seasonally adjusted basis, down from 181.9% in the second quarter. In other words, it says Canadians owed $1.82 in credit market debt for every dollar of household disposable income in the third quarter. This high level of debt leaves many households vulnerable to interest rate hikes or job losses, which could further weaken consumer spending and economic growth. Another factor weighing on the Canadian dollar is the country's growing trade deficit. In 2020, total Canadian merchandise trade recorded the second largest one-year decline on record, plummeting by 10.9% to $1.06 trillion in value. Canadian merchandise exports contracted 11.8% and merchandise imports were down 9.9%. This deficit is mainly due to the ongoing weakness in the energy sector and the country's reliance on imported consumer goods and machinery. The trade deficit is a major concern for the Canadian economy, meaning more money flows out of the country than in. This can put downward pressure on the value of the Canadian dollar, as there is less demand for the currency in international markets. It can also make it harder for Canadian businesses to compete globally, as they may face higher costs for imported inputs and may struggle to find buyers for their exports. But perhaps the most significant factor weighing on the Canadian dollar is the growing sense of political and economic uncertainty in the country. In recent years, Canada has been grappling with several major challenges, from the 2020 COVID-19 pandemic to the rise of populist and nationalist movements worldwide. These challenges have put pressure on the Canadian government to take bold action to support the economy and protect public health, but they have also raised questions about the country's long-term economic and political stability. One primary concern is the growing level of government debt in Canada. According to the International Monetary Fund, Canada's gross government debt to GDP ratio reached 117.8% in 2022, up from just 88.9% in 2019. This sharp increase is largely due to the massive fiscal stimulus measures that the government has implemented in response to the COVID-19 pandemic, including direct payments to households and businesses, as well as increased funding for healthcare and other essential services. While these measures have helped to support the economy in the short term, they have also added significantly to the country's debt burden. This has raised concerns among some investors and analysts about the long-term sustainability of Canada's fiscal position, and has put pressure on the government to find ways to rein in spending and boost revenues in the coming years. Another major concern is the growing level of political polarization and regional tensions in Canada. In recent years, the country has been grappling with several divisive issues, from the ongoing dispute over pipeline projects in Western Canada to the rise of separatist movements in Quebec. These tensions have put pressure on the federal government to find ways to balance competing regional and ideological interests, while also maintaining national unity and stability. The uncertainty and instability created by these challenges have weighed heavily on the Canadian dollar, as investors and businesses have become increasingly wary of the country's long-term economic and political prospects. This has led to a growing sense of pessimism and risk aversion among market participants, which has put downward pressure on the currency's value. So what does all this mean for the average Canadian? In short, it means that the purchasing power of their money is slowly but steadily eroding. When the value of the Canadian dollar falls, as it has been doing in recent years, it takes more of the currency to buy the same amount of goods and services. This means that everything from groceries to gasoline to imported consumer goods becomes more expensive, putting a strain on household budgets and reducing the overall standard of living. According to Statistics Canada, the Consumer Price Index, or CPI, which measures the price of a typical basket of goods and services consumed by Canadians rose by 6.8% year-over-year in 2022, the highest annual increase since 2003. This means that the average Canadian household spent an extra $2,000 on goods and services in 2022 compared to the previous year, simply due to inflation. Russia's invasion of Ukraine in late February continued to affect energy, commodities, and most notably, food prices. With the unemployment rate falling to a record low in April, strong employment figures tend to put upward pressure on prices. In April, average hourly wages for employees rose 3.3% on a year-over-year basis, meaning that on average, prices rose faster than wages, and Canadians experienced a decline in purchasing power. But the impact of a weaker Canadian dollar goes beyond just higher prices at the checkout counter. It also makes it more expensive for Canadian businesses to import the goods and inputs they need to operate, such as machinery, equipment, and raw materials. This can lead to higher production costs, which can in turn lead to higher prices for consumers or lower profits for businesses. A weaker Canadian dollar can also make it more difficult for Canadian businesses to compete in global markets. When the value of the currency falls, Canadian exports become more expensive for foreign buyers, which can lead to lower demand and reduced sales. This can be especially challenging for businesses in sectors that are heavily dependent on exports, such as manufacturing, agriculture, and natural resources. On the flip side, a weaker Canadian dollar can also make Canadian assets and investments look more attractive to foreign buyers. This can lead to increased foreign investment in the country as investors seek to take advantage of the lower costs and higher potential returns. However, this increased foreign investment can also lead to concerns about the loss of domestic control over key industries and resources, and the potential for increased economic instability and volatility. The Canadian dollar's lackluster performance against the US dollar has also been a notable curiosity in 2024, particularly given the recent spike in oil prices. Canada's economic woes relative to its southern neighbor and a potential divergence in monetary policy are likely behind this development. As Canadians continue to believe that rate cuts will be more aggressive on their side of the border, we still see the US dollar-Canadian dollar moving above 1.40 in H2 2024. This means that the Canadian dollar could weaken even further against the US dollar in the coming months, as investors anticipate a more dovish stance from the Bank of Canada and a wider interest rate gap between the two countries. Of course, predicting currency movements is never an exact science, and there are always risks and uncertainties that could alter the outlook. For example, if the global economic recovery begins to falter, or if there's a sudden shift in investor sentiment away from the US dollar, the Canadian dollar could strengthen again. However, based on the current economic and policy trends, it seems likely that the Canadian dollar will remain under pressure in the near term, even as oil prices continue to rise. This would undoubtedly have significant implications for the Canadian economy, as a weaker currency makes imports more expensive and can lead to higher inflation and lower purchasing power for Canadian consumers. Ultimately, addressing the challenges facing the Canadian dollar and the broader Canadian economy will require a concerted effort by Trudeau's Liberal government, businesses, and individuals alike. It will require tough choices and sacrifices in the short term, but it will also require a long-term vision and a commitment to building a more sustainable and prosperous future for Canadians. If you like this video, hit the like button and help us spread the word. And don't forget to subscribe to get notifications on our latest news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.